Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. I'm thrilled to be joined this week by investment strategist Ryan Grabinski to talk all things markets. Ryan, how are you doing today?
I'm doing well. Always good to be back.
Yeah, good to have you. I love our conversations because they're very high level and they can cover a lot of ground. You're very good in that arena. So let's start with the Fed, with inflation. It's been the driver of markets this year. It's been all anyone wants to talk about. So how are you thinking about what the Fed has to do, the challenge in front of them, and really the kind of longer term picture there?
Sure. Yeah. So, obviously, the Fed has been very topical this year. We get almost on a daily basis, we at least get a client or two asking us a question about our thoughts there. So certainly makes a lot of sense. Overall, we finally believe that the market is finally believing that the Fed is going to be serious about fighting inflation. For a period of time there, the market was pricing in cuts in 2023, but it doesn't seem to be the case anymore. And they really have come around to the idea that the Fed is going to stick to their guns this time around. One of the things that we always like to highlight is that in previous tightening cycles, the Fed funds the Fed's funds rates has to exceed the rate of CPI before the tightening cycle ends. And this really leads us to conclude that it's really premature to believe that the Fed is ultimately going to pivot here.
Yeah, I think over the last 6 weeks, the Fed and all of the members of the FOMC have done a really good job of getting out in front of people and saying, look, one print that beats expectations is not the job done. We have a long way to go. There's still too tight a labor market, et cetera, et cetera. So with that in mind, so the Fed's going to be raising rates into the foreseeable future. Inflation is still a problem. In addition to all the other things going on in the world, how does that impact your view of corporate earnings for next year? And how do you all compare to what the consensus is?
Sure. Yeah. So, obviously, we've been of the view for some time that 2023 earnings estimates have to continue to decline here. Obviously, we have our recession odds are at about 50% right now. And if the market were to see a recession in 2023, typically earnings decline, roughly 30%. Now that's using based on the averages. You can say, okay, but that's an average. You have some extreme scenarios like the financial crisis where they were down 90%. So if we take the median, even so with the median, they're down 24%. At the end of the day, the consensus estimate has only come down 3.3% from its highs just back in June. And so, we're of the view that estimates have to be revised lower. Our earnings estimate for 2023 is 233, which is below the street estimate of 243 right now. But even so, if we really get that recession scenario, we may even have to revise our outlook further lower.
Right, and thinking about the S&P 500 in aggregate, right? We know that that's a cap-weighted index that's pretty top-heavy, and a lot of those names at the top, the big names that have really been leaders for the last decade, have struggled this year. And so not only will that probably be reflected in those earnings that you mentioned, but it's something for investors to kind of more broadly consider. We talked to your colleague Chris Ferrone, and he likes the idea of owning the average stock over the top of the market. And I'm curious if you have any additional thoughts there on what that kind of concentration risk means for investors.
Yes, certainly. It's, there's been a big, I'd say over the last 10 years, there was a big push towards the passive investing. And I think that actually is an underappreciated risk that investors might be taking. The top 5 constituents in the S&P make up roughly 25% of the overall index. And, if you look at the sectors that those companies are in, it's technology, communications, consumer discretionary. Those are 3 sectors that we don't have a favorable outlook for right now, as a lot of our sector positioning is actually focused more on the defensive sectors like utilities and staples. And we also have a favorable view towards energy as well, which happens to be defensive as at this point in time.
Yeah, exactly. So I think that's a great way to end. That's a lot to chew on, but some kind of actionable strategies and sectors that you all like. Brian, thanks so much for the time as always. It's been really insightful, and hopefully we'll get to talk to you again soon.
Thanks a lot, Ross.